Hello there. Welcome aboard. Glad to have you here. Hey, it's Walter here, and you're here at the Naked Trading webinar. Glad to have you here. We're going to talk about trading exits today and how to maximize your profits. So that's what we're going to talk about today. And I'll share with you a way to figure out for yourself what you should be doing in terms of maximizing your profitable trades. Obviously, with the losing trades, that's a different story. We'll talk about that tomorrow, actually, the losing trades. But today we're going to talk about the profitable ones. So how does this work? What am I talking about? Well, first of all, you have to understand who you are as a person and as a trader and what you're looking to get, what your goals are to get this right. And in the Small Accounts, Big Profits course that's coming up, you can get the link below or above this video. You should find a link about that course. The goal of that course is to take a small account and build it up quickly. That's the goal. So everything that comes with that is what we have to learn to deal with. Now, if you, as a trader, if you would rather have a situation where you have a profitable trade and you make some profit rather than making potentially a lot of profit, then that's one sort of mindset. So let me give you an example. Let's say that you have a trade where you're risking $1,000 and the trade is up $1,500. So you could say, yeah, I've made $1,500. I'm going to get out of this trade. I'm done. Or you might say, I'm going to hold on to it a little bit longer and see if it can go further for me. Now, if you cut that trade at $1,500 and you pull out and you're done, then you've made money. But what if the market then goes another $500? It goes up to $2,000. You would have made $2,000 had you held on to it. See, or it could have also been the case where you have $1,500 in profit, but then you don't get out and the market retraces against you, and then you're down to only $1,000 in profit. So you have to decide which one of those scenarios is more difficult for you. Is it scenario one, where you lose out and you could have had more profits if you held on to the trade longer, or the situation where you actually held on to the trade longer and you lost some of the profits that you had? So if it's number one, if that's the more difficult thing for you to deal with, then you need to use either profit targets or really tight trailing exits. If that's not the case, if scenario number two, where you made $1,500 and then you lost $500, if that one is more difficult for you to deal with, no, sorry, I got it wrong. That's the one that you want to use tight targets, tight profit trailing exits to capture profits, or you want to use profit targets straight up. Just if it hits here, I'm out. But if you're okay holding on to a trade and seeing the market go against you a little bit, then you can use the trailing exits. So I've totally flubbed this up. Let me make sure I'm really clear on this. If the more difficult thing for you to deal with is to see the market go further than you had and give you potentially would have given you more profit had you held on to it, then you can use a loose trailing exit or a trailing exit full stop. If, however, it's really painful for you to have profit, quote, in the bag, and then you lose that profit because the market goes against you, then you need to use targets or really tight trailing stops. Okay, so let's talk about this because this is quite important. All right, I want to share with you glad you liked the book. I'm glad to hear it. That's awesome. Hope it helps. And here, yeah, several traders here have read the book, which is great. And what I want to do here is talk about this boat, actually. And some of you may have heard of this story. This is the story of the Costa Concordia. Did anyone know this story? So basically what happened here was this fellow, there was a what do you call it? Like a captain of the ship. And this was in the Mediterranean. And essentially what happened was the ship sank. And there was a really big stink about it because the captain of the ship, depending on who you talk to his lawyer, he actually made a maneuver when the ship hit these rocks that were uncharted. They didn't know that these rocks were there in the Med. And the ship hit it. He made a maneuver that saved a lot of people's lives. A lot of people died. It was a tragic story. And then he apparently fell off the ship and landed into a lifeboat. And then there are stories that he was ordered to go back to the ship, but he didn't. So people said that he abandoned the ship quickly. So I don't know if it's true, if he actually did abandon the ship quickly, and he should have stayed with the ship, as I guess most good captains are meant to do during some sort of disaster like that. So it depends on who you talk to, but that's kind of like what we need to do as traders. We need to decide. See, he had to decide when he got off that ship, is it worth it for me to get off this ship and potentially save my life, knowing that maybe some people are going to say that I'm a Captain Coward or whatever, and they call him all these names now. I think he actually went to jail for this because several people died, and they said he was negligent, basically. Or should I stay here with the ship and do what good captains are supposed to do? I don't know. Did the captain of the Titanic sink with the ship and all that? I don't know the story, but that's basically what he had to decide. And it's the same thing as traders. We need to decide, what are we going to do? What on earth can we do here to make it so that we're happy with our decision? Same thing with that captain there. He had to do the same thing. He had to be happy with his decision. So let me share with you this chart. And this is one that we've talked about. I don't know if you've seen this before, but this is the Swiss yen 4-hour chart. And what we're looking at here is we're going to look at the market advance and go further. So let's say here that this is just an example, but it shows you the value of this. So see how the market broke through this support level here at 111.90, and then it fell through, it came back up, touched it again, and printed a bearish candle. That's called a pinch trade. And my friend Dennis in France actually alerted me to this. He's a great trader. One of the great things of working with traders around the world is you actually get to learn things. And one thing I've learned, amongst many, is Dennis's pinch trade. So this is what we call pinch trade. That's what Dennis calls it. So it's what I call it. And it's basically you fall through support, or you break through resistance, and you come back down and bounce off of it. So this would be a sell below the low of this candle or below the low of the bearish candle, whichever one you want. It's more conservative to go below the bigger candle. So let's see what happens here. The market does trade lower there. So now we're in and we're selling. Now let's say we're using this moving average here as a trailing exit. If that's the case, we would wait for the trailing exit moving average to point upward and to indicate that the trend is over. So we'd be in right here. I'd sell right here. I'll make this like a green line or something so that we know what the heck's going on here. This is my sell spot, and it's right there. Boom. Now, when am I going to get out of this trade? How far is it going to go? Now, this is just an example, but it highlights really the important aspect of trailing exits that you need to think about. One is, what do you like to do? Are you okay giving back a bit of profit in exchange for a lot more profit occasionally? Or would you rather just have your profit and you don't really want to give back too much? So in this case, you can see this 4 exponential moving average is still going down until it's at 111.20 and 111.21. So at this stage, we would get out, and this trade would have been good for 35 pips, 34 pips, 35 pips. That's it. 35 pips is all I'm going to get out of this trade. Okay. Now, what if instead of using a 4 exponential moving average, I'm using a 6? Not a big deal, right? Just very slightly different to what we're talking about here. Well, it turns out that we would still be in this trade. Actually, let me change that color because I don't want it to blend in with the candles. Let me just make it red or whatever so you guys can see it more easily. But look at this. We're still in this case. It's still going down. 111.23 and 111.23. So we haven't moved at all. Actually, it went down 3 pipettes. So it's flat / slightly down. Then we see the market goes further, and we're out here, I believe. So it went from 110.21 to 110.22. So there you are. So now you're out. So in this case, instead of making 34 pips, 35 pips, whatever that other one was, you're now making 130 pips. So it's a big difference, right? But here's the thing. The only way you're able, and that's obviously a cherry-picked example, okay? Fine, fair enough. But here's the thing. You're only allowed to do that if the market actually goes. If it goes. So you only get that extra profit if the market keeps going. If the market didn't keep going, then what's going to happen here? I'm actually going to, because I have a looser trailing exit using the 6 exponential moving average instead of the 4, what that means is I'm going to take deeper losers occasionally, right? Because like a full loss. So for example, if the 4 exponential moving average is moving, I can trail it, but because it takes more movement against me for the 6 exponential moving average to change the price of the moving average, it takes more of that. It's got to move harder against me. So that means I'm going to have more losers, but I'm also going to have more big winners. And that's really the key. I like trading that way. A lot of people don't. You may not. You may prefer to take the small winners. Just know if you do that, you got a couple of things to think about. One is your broker slipping you, because if you're taking small winners, if your broker's slipping you once you start making money, or the broker knows you're making money, that's going to count against that. That's going to chip away at your profits. And number 2 is if you're doing that, taking small profits like that, you need to be really on your game. You have to be mentally sharp. If you screw up just a tiny bit, it can really hurt your overall profitability. So you don't have as much cushion that you do if you're trading for bigger profits. So I just wanted to share that. It's a simple exit strategy, the exponential moving average. If you want to get more information about different ways of getting out of trades and different ways of compounding accounts at the trade level, that's all in the small accounts, big profit scores. You can click the button, the link, wherever it is.